Alright, in this short video I'll demonstrate how we use IRR to evaluate business decisions. Joe is trying to decide if it's worth his time and effort to get into the lawn mowing business. If he invests $18,000, he can buy a lawnmower, beat up pickup truck, get into the lawn cutting business, and he can do it for 5 years and then move on to another business. Okay, so he made some revenue projections, and where did he get these? He did some forecasting. He went out there and looked in the market. He figured how many lawns he could mow, how many days, what it would take, word of mouth for the word of mouth to get around, or the impact of advertising, all those other business things that people do. So after he's made his projections, he's figuring that the revenue starts out slow but gets bigger. His expenses are a combination of cost of goods sold, that's gas for the lawnmower, gas for the truck, depreciation on his equipment. There's the fixed expenses. He's got to have a phone, he's got to have an office. But he projected out his operating expenses, and given that, that's what he figures his pre-tax profits are, revenue minus expense. The taxes, he's figured in a 33% tax rate on this. That's taxes on everything, or his income taxes on everything. So that leaves him with an after-tax profit in each of these years, and he wants to figure out what rate of return would that be on an $18,000 investment. Because remember, he doesn't have to get into the lawn mowing business. He could do something else. So he wants to know what rate of return he's going to be earning on his $18,000 investment. Okay, piece of cake. The easiest way to do this is just to add a row into our table. At year 0, his initial investment will be a cash flow. So he'll have to spend $18,000 at time 0. So the total cash flows would be the sum of the initial investment and then the after-tax profit columns. So if he spends $18,000 today to get into the business, and then each year he makes these cash flows, what rate of return would that be? Well, that's where the IRR function comes in. And how we would interpret this is that's a 35% rate of return on his money. Okay, now he could compare that to other businesses. 35% might be good and it might be bad, but now he's got a benchmark to go by. That's the equivalent, assuming that business and his projections turn out like he said. If this is the reality, then this is the amount of interest, if you want to call it, or yield it'll earn on an annualized basis for his $18,000 investment. Now, this is the same process that Boeing goes through when they're trying to figure out, is it worth it to go buy a new 787 Dreamliner plant and build it in Charleston, South Carolina. It goes over a longer period of time, not 1 year, but 50 years, and the numbers are going to be in the billions, and they're going to be a lot more complicated than all of these, but they got an army of accountants and finance guys to work on projects like this. But that's the same basic concept that they use and come out with, is it worth it? Now, Joe could also compare this to some other business. Say he was going to get into the cash flow business from a bar. That was the other thing he thought he might be able to do. Now, I'm not going to do the math on the bar thing, and I'm just going to make up the numbers. But let's say he figured he could invest the $18,000 in a bar, and it'd generate $14,204 the first year, $13,400 the second year, $10,586 the third year. Then it starts tapering off, 7,370, and then 3,350. By the way, these are exact same cash flows. I've just reversed them. But this is the cash flows from the lawn business, where it starts off slow and picks up. This is the cash flow from his bar business, where it starts out fast and then slows down. Notice that even though the cash flows add up to be the exact same amount, the IRR is much higher for the bar business. That's because he gets his money back faster and he can invest in something else. So if he was trying to choose between these, which would you rather earn? 35% on your investment or 60% on your investment? Assuming they were the same risk, I would rather earn 60%. But that's where it starts to get a little bit more complicated.